When creating wealth through retirement, debt is super important to be structured correctly. I have this concept between good debt and bad debt, and I think it's important I go through a few things for you today. It can literally save you thousands and thousands of dollars, and it's not by changing the interest rate. It's all about how to structure it from a tax perspective. So the key thing is when we take out debt is what it's used for. So if we borrow money to buy something that doesn't produce an income, we call that bad debt. Okay, so you can imagine anything that you bought on a credit card, I'd assume that you're not going to generate an income from it, so we call that bad debt. Interesting, if you borrow money to buy a home, we call that bad debt because it doesn't generate an income. What good debt is though, is when we borrow money that buy something that does generate an income. Now it may be we borrow some money to buy shares, or we may borrow money to buy an investment property. Now because we're buying something that then generates an income, that debt is then tax deductible, which is quite nice. It can reduce the level of tax you're paying and you may actually get a tax refund, while the investment hopefully then grows in value. So it's really important when we're looking at debt to do this correctly. Now while we're on the topic of debt, and particularly good debt, I might just explain the concept of when we borrow to invest. Now it's quite simple. For example, what we're trying to do is if we're borrowing money, let's just say it's 6%. The interest rate may be much higher than that when you watch the video, but I'm just using 6% as a guide. If we borrow money at 6% and we're going to invest, whether it be a property or shares, what we're hoping to do is the total return to exceed 6%. I'm just going to use 8% as an example. So what you can see there, if we're borrowing money at 6% and we're getting a total return of 8%, we're getting a total return of 2%. We're making 2% using the bank's money. And that's what basically using good debt is an extreme advantage for creating wealth. There are a number of considerations though, because when we borrow money, it can be like we call it a two-edged sword, because this investment, it may go up by 8%, but at times it can also fall. And that's the risk that you take, that when you borrow money, that the investment falls in value rather than goes up in value. So that's something to really keep in mind, especially if you're investing in shares and property. The value doesn't always go up in a straight line. There will be times that it will be going up and down. So there'll be times where you'll think, wow, is this investment actually really worth it? So if you are considering borrowing money for investment, it can really help your wealth creation. But I guess the main thing you need to keep in mind is it's got to be for the long term. We've got to be able to go through those down cycles and wait for a really strong return, and hopefully, as I say, a rate that exceeds the interest rate. If you are interested in creating wealth using debt and optimising your debt to claim a tax deduction, we'd highly recommend that you get advice. So please reach out and we'd love to help.